Hello everyone, this is Chuck Carnival, co-founder of FastGraphs, the Fundamentals Analyzer software tool. This is one of a continuing series where subscribers to our YouTube channel have asked me to cover certain companies. And today I'm going to be covering Carnival Corporation, or better known by some as the Carnival Cruise Line. Of course, they also have several other cruise lines, as you can see in this shot from their website. But what I want to point out before I go any further here is that this is the subscriber series. These are not necessarily companies that I'm recommending. I'm simply doing this because subscribers have asked, and I'm trying to find companies that I think are interesting among that group, but also companies that I think provide a message or an investment lesson. So let's take a look at Carnival Corp based on what we see with FastGraphs. And I'm going to start with adjusted operating earnings here. The orange line is simply a plotting of the company's earnings going back to 2000. And the multiple that line is drawn with is a PE ratio of 15. So no matter where I touch this orange line, I want you to notice the PE ratio is 15. Now, there's a couple of things that this graph does. First of all, it gives you some good insights into what the business is like. So I'm going to take monthly closing stock prices off, and I want to focus on the business. I see a lot of cyclicality here. The white line is a plotting of dividends, and the light green shaded area are those same dividends after they've been paid out. This is when they still belong to the corporation. This is when they've been paid out. Now, this is the Great Recession of 2008. I want you to notice that the company completely eliminated their dividend in 2009, and then they started paying a dividend again in November of 2010, and that dividend has actually grown pretty nicely and is forecast to continue. So when I put price back on the graph, I do want you to notice a couple other things here. Number one is, people talk about what's the best valuation metric. And I'm using adjusted operating earnings here, or the PE ratio of 15 times operating earnings. And I want you to notice that this is really a great back test here. You can see that the price has gone where the earnings have, and there are short periods of time where they get disconnected, but they always revert back to the mean. Now, coming into the recession, Carnival was somewhat overvalued back in January of 07. Then the price fell precipitously. The PE ratio got down to 6.5 by January of 2009. Of course, that's when they also cut their dividend. And then the earnings also fell, but the company did stay profitable. And then again, they started paying dividends again, and the stock price has risen since. If you look at the company statistically right now, you'll notice that the blended PE ratio is 12. That's very attractive. In other words, the price is significantly below the orange line. The dividend yield is 3.8%. The company is A- rated and only has 25% debt on the capital structure. So at this glance, the company looks really, really good. And I would suggest that it probably does look like an excellent investment. If I go to the forecasting calculator, one of the things I often talk about when I do these videos is I never buy a stock hoping I can make money or hoping it might go up. I buy a stock with as precise as I can justify, or as precise a forecast as I can, precisely how much money I think the stock can make me over the next 1, 2, or 3 years. Now, I usually don't go out more than 2 or 3 years when I do this, but this is a PE ratio of 15, a forecast growth rate by 23 analysts that the company is going to grow earnings at 6.8% for fiscal year ending in November of 2019. I want you to notice that's a November fiscal year. And then they expect 11% growth the next fiscal year. And then the number of analysts starts to drop off, but we still see some good growth. So we're looking at about a 10% average out to fiscal year end 2022. But if I only look out the next year, year and a half or so, out to November of 2020, and look at what my performance, I could make 30% or almost 31% annualized rates of return. Because what I'm looking at here is an earnings growth rate where I get 7% this year and 11% next year. And then so the earnings go from, $4 and let's say 30 some cents currently in between these two numbers, up to $5.06. I'm buying it at 12 times, current earnings, and I'd be looking at valuing it at 15 times the larger earnings out here in November of 2020. That would give me a 30.9% annualized rate of return. It would give me a pure total rate of return of about 48.75% between now and November of 2020. So that's very attractive looking. Okay, but I want to go back to this historical graph, and I want to make a couple of points here when looking at this company. It looks really good on first glance, But when I'm looking at dividend paying stocks, and it offers a 3.8% yield, which is very attractive in today's market, in addition to the capital appreciation of the reversion to the mean that I discussed a moment ago, let's look at some cash flow. So let's start with operating cash flow first. When I'm looking at their historical operating cash flow, we did see a little dip in operating cash flow during the time when the company cut their dividend, but there were ample cash flows here to cover the dividend. It's one of the things I look at when I'm looking at operating cash flows. I'm really looking at dividend coverage. I'm not as concerned about price. I'll even take price off the graph. What I'm concerned about, do I have enough cash flow to cover the dividend? So if I was looking at this stock back here prior to the dividend cut at this time, and I'll go just before the Great Recession, and this is before I knew that this dividend was cut here, I'm suggesting, so I could bring it back another year. But my point is, during this period of time here, it looked like there was plenty of cash to cover the dividend. But next, I want to take a look at even the more important free cash flow. Now, when I bring free cash flow up, I want you to notice a couple things. Let me go back to the all graph first, that the dividend was cut during the Great Recession when free cash flow was falling precipitously. So I didn't really research this thoroughly. I can't tell you. I'm assuming that management felt that, their free cash flow was turning negative here and it was falling precipitously, and therefore they weren't comfortable paying a dividend. Therefore, they cut the dividend. And of course, as I showed you earlier, the price did react during this period where the price did drop precipitously. And again, price is not or free cash flow is not really a valuation metric. It's more of a dividend coverage metric. But they eliminated their dividend when the free cash flows fell. Now, as I showed you earlier, currently, based on operating earnings, the price looks attractive based on operating earnings, but now I want to focus on the dividend. Free cash flow has once again fallen precipitously it actually is expected to be negative for, the fiscal year ending November of 2019. Now, I'm not suggesting or saying that this company will cut their dividend at this point. You can see the forecast here for negative free cash flow. I'm simply saying that there is a possibility that the stock would be vulnerable again to a dividend cut. And so this is something I'd be very concerned about when looking at Carnival Corporation right now. The company looks great on an operating earnings basis. The valuation looks very attractive. And I can look at other metrics that I like to value. I can look at EBITDA and the price to EBITDA, the EBITDA multiple. And once again, the stock looks extremely attractive. This is another valuation metric that I like. I see some very nice correlations. This is more of a sales cash flow type of, because it's earnings before interest, taxes, depreciation, and amortization. So it's more a good reflection of how the business is performing. And the stock looks very, very attractive here. But I want to remind you, free cash flow has all but disappeared, or is expected to all but disappear this year. So the real question is, and this light green shaded area represents forecasts, will these forecast dividends actually materialize, or will the company be inclined to cut their dividend? Again, it's a caution for anybody looking at this stock now that I think I want to offer you. It's a good company. It's A-rated, 25% debt. The real question is it going to continue to pay the dividend going forward from here based on what you saw with free cash flow? It's something I would try to research fully before I invested in the stock. Anyway, this has been Chuck Carnival saying thanks for watching. This is, again, the subscriber request series. If you like what you see here, go ahead and hit our subscribe button below and subscribe to our YouTube channel. I plan to be doing a lot more of these videos here coming up in the near future. Thanks for watching.